we don't have an affordable housing crisis. We have a
That's a
zoning
great
crisis.
buzzword, isn't it?
Yeah. We have zoning. You get rid of zoning, you have no affordability problems because you can build whatever you want wherever you want, right? And there's
I
a lot of people
agree.
that need housing, so you could build housing in more places. So
Nice.
yeah,
Yep.
and same thing with self storage. So you got to be careful, right? Because you might be offered an opportunity to buy a property in a market that, oh, this is commercial zone, you can put storage there, and then you peel the layers of the onion back and you find that there's a moratorium, or you find that there's restrictions, or it requires a CUP, which is going to be risky in the entitlement phase.
Welcome to the Xplor Show, where we dive into the worlds of entrepreneurship, real estate, and motivation. Each week, we bring you inspiring conversations with people who are exploring new frontiers and shaping the business world. Thank you for tuning in. Now let's get to the show. Hey, welcome back to the Xplor Show with Scott and Ryan. Scott, how's it going?
Hey, Ryan, doing pretty well. How you doing down at the lake today?
Doing good. Yeah, my little brother's getting married, so I'm down at the beautiful Lake of the Ozarks. Pretty excited for that.
Very
But
nice. Memorial Day weekend. It's going to be busy.
yeah, it's gonna be crazy out here. This lake gets nuts. But we have the president and chief investment officer and co-founder of Spartan Investment Group on with us today. Spartan Investment Group was started in 2014 and has been rapidly growing. In 2022, they were named one of the fastest growing companies by Inc. 500. Welcome to the show, Ryan Gibson. Ryan, thanks for coming on.
Thanks for having me, Ryan and Scott.
Yeah.
Yeah, so we really appreciate you coming on. I got your contact info from another guest we had, Yona Weiss, spoke very highly of you. I'm very excited to get to know you and get to know about Spartan. Why don't you just give us kind of your intro of yourself, and we'll kind of get into how you and your partner started Spartan Investment Group.
Yeah, appreciate Yona giving me the referral. We actually had his company do all of our cost segregation studies.
I was going to ask that. That's awesome.
for our self-storage facilities. So
how did you run into Yona?
I was on an Adam Adams podcast years ago, and Yona, so diligently followed up with me on LinkedIn and said, "Hey, you were a guest on the show, and I do this cost segregation stuff. Why don't you just, why don't we connect?" And so
that's awesome. Smart man. Yona knows cost segregation better than anybody I've talked to.
Yeah, so it was cool. I think that was like 2017. Actually, it was like a long time ago. And so he did every single one of our studies. We do it a little bit differently now, just because we brought the accounting in house. But they did a great job and did all our cost seg. And so he's been on a couple of my webinars and talking about how to do cost seg for storage and all that stuff. So it's been great. Yeah.
Shout out Yona.
Yeah.
The cost seg king, guys. But yeah, go ahead, Ryan. Tell us about yourself, how you got into the business, and what's going on at Spartan Investments.
Yeah, so we started in Washington, D.C. My business partner, who was also named Scott, he was in the Army and still is actually in the Army Guard. Served in Iraqi Freedom and was my neighbor in Washington, D.C. We bumped into each other. I actually convinced him to buy the house next door to me, where the house was for sale, and he convinced me to start a business with him. So that was pretty cool. And yeah,
now, did that happen over cocktails or what?
Lots of barbecues in the backyard and
okay.
Lots of hanging out and having dinner parties.
Nice.
Yeah, we just had a similar mindset. He was working for the VA. He had a really well-paying, good position there in leadership. And then I also was an airline pilot and served as a chief pilot actually for a little while. And we were entrepreneurial. Actually, I was probably the more entrepreneurial, but Scott wanted to start an organization that really built leaders and had a good corporate culture, good staffing plans, and had strategy and vision. So kind of the desire for me to be entrepreneurial and the desire for him to build something awesome for people really flourished and built Spartan. So really excited about that. We started kind of like how a lot of people start. We literally flipped the house in between our two houses and did kind of what we were familiar with. And it was really funny. We'd have our friends over all the time for dinner parties. And we had a couple of projects going on. We had used all of our own money for our first few projects.
Mm-hmm.
And we had this awesome project that we wanted to do that we couldn't do because we had used all of our money in our own projects, and it was a really good deal. So we got this, this natural idea to say, hey, why don't we just pool all of our friends and family money together, and we'll do this project that was literally in the neighborhood where all of our friends and family, our neighbors lived. And so our first flip syndication was this condo development where we built this. We took a brownstone in Washington D.C. and kind of tore it down to the studs and built a 50-foot condo building and syndicated it. Yeah. So, and then
how much did you guys have to raise for that project?
A whopping $455,000.
And that was all family and friends.
Yeah, so it was actually it was all neighbors, which is hilarious.
Oh, nice.
Like literally, it was everybody in the neighborhood that were hanging out with us. I don't know if there was any family money in that actually. Technically, maybe there was one $50K in there.
That's awesome.
Money. Yeah, so it was cool because people were familiar with the neighborhood, they were familiar with real estate, and they knew who we were. So it was kind of like the three perfect things that every passive investor looks for. Is
and in the back of your head, you're thinking, we better not screw this up, or we might have some problems.
Yeah, exactly. So yeah, that was good. A lot of things went wrong with that project, but we made some good money. So that was good. We bought right, but the contractor was a little bit difficult to work with, but it was okay. It was a fun project, learned a ton. And we wanted to get into something that we could scale. So we wanted to be the operator, so that meaning that we were doing all the property management, all the construction, and we wanted to find and acquire properties. And so we sat down one day and said, hey, we're going to come up with evaluation criteria. So we're going to pick an asset class. We're not sure which one yet, but the three things that we wanted was easy to own, easy to evict, easy to maintain. So the 3 E's. And so that quickly eliminated a lot of things like multifamily, assisted living, et cetera, because those were not easy to own, easy to evict, easy to maintain. So we came up with storage. And so that kind of bubbled to the top. And sort of what wet our whistle on that too was our first deal, we actually, people say, how did you get into self-storage? Well, we studied and learned, went to conferences and stuff, but we also invested passively in a syndication where, we looked over the shoulder of another operator and got familiar with the industry and got familiar with some of the techniques of construction, how they kind of leased up, and with, how they were sort of thinking about the business plan. So that's actually how we kind of got our first deal done. Was a passive investment. And then, a couple
That's
years
a good
later,
way to kind of learn it, though, from, put a little bit in, but don't risk everything necessarily right away, so that you could start to see kind of what it looks like, how it works, and understand that whole model, right?
Yeah, exactly. And that's why we were able to do our first deal was a ground up construction project and just outside of Seattle. Very difficult project.
You guys went all in.
Yeah, we went all in. I mean, this is a $15 million build.
Wow.
It required an act of Congress to move the wetlands. Literally, I called my congressman because we were stalled on the wetland mitigation plan. So I had to get a congressman involved. We had to do 11 easements. We ran into all kinds of financing issues with COVID, and just the nature of being a brand new developer and building a big property like this with your first one. We naturally, like a lot of no's, right? A lot of people didn't want to do it because A, you have no experience building these. B, you have no experience operating.
You guys really had some balls going in and doing a wetlands project on your first project, because that is not an easy deal.
Yeah. So that was. But it's funny that was a rezone. We had to work with the tribes. We had to work with the Department of Ecology. We had to work with Fish and Wildlife. We had to work with the Army Corps of Engineers. 11 easements. Jesus. It was a full conditional use permit. And the best thing about it though is we came out the backside of that. We got a beautiful property that we built. That's going to do very well. It's leasing up, and really nice facility. And the thing is we learned the hard way. Yeah. And now
you guys came out of that first project. You went all in financially. You also went all in with the hardest possible development you could do when you're talking wetlands, all the EPA stuff. I mean, everything else. What else did you have to learn?
Exactly. Yeah. I mean, we literally cut our teeth on just about everything. And it's funny. Our second project, this is worth kind of mentioning. We bought this tiny little storage facility in Conifer, Colorado. This was an off-market deal. We were sending letters and doing the whole off-market strategy. No secrets there. I mean, we just
what year is this roughly, by the way?
That was so we did resi up until about 2017, and then in 2016 we said, hey, we're gonna no more resi, stop doing it, and let's focus 100% on storage. So we stood everything down, and then we went on this educational blitz, kind of learned everything we could about storage, and then our first. So we put that project that I was talking about under contract in about 2017. It took about 4 or 5 years to just entitle it. Just because
not unheard of with all that stuff. Yeah, it takes a lot of time.
Yeah, and then coincident, we were trying to find existing properties, and so our first existing property closed in I think it was the fall of 2018, August of 2018, and it was this little tiny 14,000 square foot property, and
tiny 14,000 square foot.
Yeah, no, that is small for storage. If you're in this, if you're in this space, you'll know that it's like 129 units. I mean, that's like a lot of multifamily units, right? But like that's not for storage. Like an average size property is
pretty tiny.
It's like 500 units. Yeah. So like people, oh wow, you got 30,000 units. It's like, well, it's we kind of measure things in square footage. So we have about 4 million square feet of storage now.
I measure in centimeters, so I see what you're saying.
Exactly.
Sorry.
No, it's fine. It's perfect. It's Friday. Let's have some fun. So we bought this little tiny property, had a half acre in the back, and it was actually built in the side of a mountain. So we actually expanded it by 14,000 square feet. And we actually ended up running into bedrock when we put a shovel in the ground. So we had to get dynamite. And we had to bury dynamite in the ground and blow up the ground just to break up the bedrock to build the foundations for the property. So we were literally building. There's great YouTube videos on it. We actually captured like the whole progress. It's like a 3-part series on our website. I can give you guys a link for the show notes if you want. But it's
we'll put a link in the show notes for sure, because that will be interesting to share.
Yeah, it's literally how we built the property, and our construction project manager walks through like every little thing, and we film it really nicely and all that.
That's very cool.
blew up this ground, and then built this storage on the side of a hill, and 8,500 feet. And what's really kind of fun, sad. I mean, I don't get emotional about storage, but that was our first existing storage, and and we're selling it in a week. It closes in a week, and so got a nice.
That's awesome! Congratulations.
Yeah, it's
so you held it for about 5 years.
Yeah, about 5 years. Yep. And
let's talk some numbers on these projects. So on your first project there in Seattle that took so long to get done, tell us kind of the financial side, what that looked like. So what the ground cost, what the construction cost, what did you raise? Tell us a little bit there, and how did you raise the money?
Yeah, that capital stack is very irregular. And quite frankly, could be a Harvard business case study. I mean,
that's why we want to talk about it.
Okay. All right. I mean, this is not your typical, this was a gritty, hammer it out, dial for dollars situation. So
again, guys, this was their first storage deal, and they went all in. So
we were not going to fail on this project. We burned our boats. So we found the land was actually, we wanted to find storage, where to build storage. So one of our employees, our first employees, who happened to be Scott's wife, she used to work for an intelligence agency in DC, kind of hunting terrorists, basically, right? So she knows a thing or two about research. So she found the area in Seattle that had the best demand for storage. So we went to this area, started looking around, didn't find any property at the time, but then found a broker that had this land actually listed for sale, and it had been listed for sale for like a year. I mean, it had been on the market for a long time. And so we bought the land for $550,000. It was 5.5 acres in King County in Washington, right off the state route. So
that's really a good price for the ground.
Oh, it's amazing price, right? But
I was going to say
half the property is garbage because it's got an acre of wetland.
That's true. That's
true. So it's commercially zoned. At the time, which required a special use permit for storage. So we bought the land for $550,000, and we took it took a few years, about 3 to 4 years to entitle. And that meant like we had to get the city to grant us the right to build storage there. And then we had to get all of our building plans and permits done. So by the time all that all happened, the land was actually worth $4.1 million. So it cost us about $1.5 million. So it took us we paid $1 million in permitting costs. That's all your that's all your third party consultants. That's your wetland. That's all the hearings you have to go to.
Really not that bad, to be honest. Today would be a lot more than that.
Yeah. Well, we would probably be more efficient today.
That's true.
We would know where to poke. We were kind of, with the flashlight in the dark room, not really knowing how to get out. Well, no flashlight in the dark room, I should say. Now we have the flashlight. Now we know how to kind of find our way around and get out the door. But the $1 million, so $1.5 million into it, and then the day we got the permits, we got an offer for the property for $4.1 million. So we could have just walked away at that point, really made a nice profit. But we said, we really want to take this. We really want to build this. We want to build this and operate it and put it in our portfolio because it's a great property. No other properties are in that market. It's very difficult to build in that market. It would take a long time to entitle and permit. And there's 10,000 houses being built within a mile. So that's really great for self-storage. So now came the financing challenges, right? So we kind of went into this thinking, construction costs were going to be right around $8 million for what we wanted to build. And I believe they ended up, or 7.5, so 7.5, something like that. So we thought, okay, $1.5 million, 7.5. We're going to do an SBA loan, which required 15% down, 10 to 15% down, depending on how you do it. And we'll go that route. Well, we just ran into all kinds of problems getting the SBA loan. They're very difficult to get. They take a long time, and they looked at Spartan like a big investment shop, not like a small business. For some reason, and it was like, no, it's just like it's just a handful of us now we don't qualify for SBA, but at the time we technically did qualify for SBA, and we were getting a lot of pushback for some reason on the SBA loan. So we were kind of jammed. So we had to think about how we could build this in phases. We were breaking up different buildings, and we just couldn't get the numbers to work right. It's like we really needed to build the whole thing, and so we just started looking for lenders. And man, it was tough convincing a bank to do this. So what we ended with, long story short,
especially being so new into it, I can't imagine.
They had every reason, and this gets harder, easier as you go. I wouldn't say it gets easier, but banks
get more savvy and educated, so you're able to get things done more efficiently, like you said before.
Yeah, and so we called dozens and dozens of local banks, and finally we found a lender. And this is insane. It makes sense, but it's kind of crazy. They gave us the appraised value of the land as equity injection. So when the land appraised for $4 million, I'm going to use easy numbers here. So land ended up appraising for $4 million. We had held the land out for 2 years. So the credit union was okay with us using that as equity injection. So instead of having, $1.5 million of equity injection, now they're going to count the appraised value of the land as $4 million of equity injection. So we were able to take out a $12 million loan with a $1.5 million equity injection. So think about the LTC there.
That's awesome.
Yeah, and then the property is worth somewhere in the mid 20s, maybe high 20s, low 30s as far as as after built. So when you think about it, we syndicated the equity. We syndicated about 1.3. We had about 200,000 of our own money into the deal. So
your investors did pretty well on that one.
Yeah,
sold it.
We haven't sold it yet, but
Jeez.
But yeah, there's a lot of equity built in that facility.
And how many units did you? So you got $12 million loan. So about $10 million in construction, roughly. Is that right?
Yeah, it's about. Then there's some lease up losses. I think the loans actually was like 12.9 or something like that.
Okay.
I can't remember the exact amount, but yeah, there's some holdback for lease up losses. Like when you build one of these things, you got to make sure you have the losses to carry the lease up, right? So you're not going to open and have 700 customers the next day. It's going to take you a couple of years.
And a lot of people forget about that, and they also don't put that in their numbers a lot of the time. But
yeah,
what are you guys on a lease up expectation for that? How long is that going to take typically?
That's a big property. That one's about 120,000 square feet. So that's going to take you, typically we want to look at leasing that something like that in 2 to 3 years. Two is aggressive. That's very aggressive. It's going to take us a full 3 years to do it. And that's pretty typical. We have a property down in just outside of Portland that we just built. But it's not even half the size, less than half the size. And we're going to fill that up in a year. So be careful what you hear people say. I think of it as kind of, think of it in a square footage percentage. Like, if you have 120,000 square feet, we're usually leasing maybe 2,000 to 4,000 square feet a month. So you kind of got to think about it that way. It's a little bit different than just thinking, my friend built one and he leased it up in a day. It's like, well, he had a tiny, he had a small facility, right? Where if you have a massive facility, it's going to take a little bit longer to lease up. So we're about 50% of the way there. We opened about a year and a half ago. So we're doing good. We're doing good. If we want,
you said that's 700 total units.
750. Yeah, 755. Yep.
Wow. So at what point do you guys? Well, so this first property is a mess. When did you start like trying to advertise to get that initial kind of boom of tenants in there or leases out? Because you could, with all the permitting and stuff, it's like, we don't know when it's going to be built.
People need storage when they need it, and it's not like
apartments or something.
Yeah. It's like I need storage this weekend because I'm moving. So it's getting a long wait list of storage tenants in advance isn't really that advantageous. You just got to make sure when you open that you let the world know you're open. You've got your digital advertising set up, you've got your website going, you can book online, you've got a good store manager, smile on the face, good customer service, getting 5-star reviews on Google, and that you've got, maybe some kind of gimmicky bannering, on the road and have a ribbon cutting ceremony. Get an ad in the paper or get an article in the local paper, like the hyper local paper, like they have this coal miners thing in the city that we're in. We got in there and you get a special and all this stuff. So, you just kind of have to have the hype in place, right?
Gotcha.
Think the guy on the side of the road with the sign, he's twirling around, we don't actually,
guys.
Yeah, right. Not but you gotta have that stuff ready, right? Because and then you start leasing up, and maybe you might do a promotion like a first month free or second month half off or something like that, just to kind of get the spark going. Right. And then timing is a big deal. We're on the heels of Memorial Day weekend. This is our leasing season, so we're going to see a lot of move-ins. I think that property's had 50 move-ins just this month.
Wow.
To date. Yeah. And that's like a typical spring leasing season. So we're getting a lot of move-ins across the portfolio now because we're positioned for our leasing season. So
where do you guys start to break even on your overhead or expenses on that? Are you there at 50% roughly?
I think we calculated about 60% on that one.
That's about right.
Yeah. I'd have to double check. There's two things.
That's all right.
Yeah, there's two things that you want to think about when you're leasing up a property like that. Covering your OpEx. So that's like your, imagine you have no debt on the property. So just your property taxes, insurance, payroll, landscaping, utilities, etc. I think we're break even on, we've exceeded break even on OpEx. And so now it's just about covering your debt service. So we're starting to catch up and get our debt service covered. And that'll hit in the, 55-60% range. And remember, people are listening to this and they're thinking like, wow, well, okay, I need to get to 55-60%. Well, it depends. It depends on your capital stack and your interest rate and, how much leverage you took and how much you're charging for the units and things like that. So,
gotcha.
Yeah, no, that's a big thing that a lot of people forget is they always try to keep everything at, okay, it's always 50-60%. But the reality is every property is so different and unique in itself. So you really gotta know what's going on every investment because they are also different.
Exactly. Yeah.
So I wanted to shift gears here a little bit and talk about another property you guys acquired. With COVID and everything, there's been a lot of commercial buildings and office buildings that are becoming vacant. And you guys acquired an old department store. It used to be an old Macy's, and now you turned it into, I don't know if you guys constructed it or you bought it this way. It's 1,106 unit self-storage building. So it used to be a department store. Is the amount of vacant office buildings, does that get you guys excited? Is that a target for you with all these buildings becoming vacant?
It can be. It can be. So, for any property, it doesn't matter if it's a Macy's or raw land or an existing facility, you got to make sure you have the demand. You got to make sure the property is well located with good visibility, and you have the drivers that will create storage demand. And just like any property, again, an old Macy's or a vacant piece of land, you've got to make sure you've got the rents in that market, and that you're going to be able to be into the property for a basis that makes you a profit, right? So that's any property. So I don't look at a Macy's any differently than I look at a piece of land when when I'm evaluating an opportunity. So, for a Macy's, it might be, oh, wow, look at that Macy's or that Kmart or that Food Lion or whatever it might be, or even Walmart's today, or some Walmart's are closing. So, it's all about what can I get the building for, right? If if I'm going to pay, a premium for the building, it might be a quick, renovation of the inside to get the units online. But, now I've overpaid for the opportunity, right? Or I might find a Kmart, Macy's, whatever, that I can buy, and there's no demand for storage there. So, I might have gotten the building for a song, and my basis is very low, but my demand is also very low. So, a heavy hitting good opportunity is, you find an opportunity like that that's got a low basis. It's got strong storage rents and demand, good visibility, and a municipality that's willing to allow you to operate it that way. You got a home run, right?
So let's talk about that. Actually,
yeah.
Let's stop there real quick. Municipality willing to allow you to operate as a storage unit. What I'm seeing, especially here, and we're looking at it here in Kansas City, there's been so much storage that's popped up around the city recently that a lot of city ordinances are future use maps are being redone, and they're not allowing any additional storage properties. Are you guys battling against that? Are you seeing that across the country?
Yeah, so some markets don't want it, and some markets, you don't get any property, you don't get any sales tax from it, and you also don't employ very many people, and people don't want storage. I mean, what are you gonna do with your storage, right? So I think a lot of city planners see it negatively. And what's really sad is, have you guys ever used self-storage ever?
Yep.
Oh yeah.
I have a unit right now.
Okay, and why do you have a unit?
So my wife and my family were travel nursing for a while, and so we put all our stuff in storage, and now we're moving back to Kansas City. So until we get a permanent house, we're renting houses that have furniture. We didn't want to move our stuff a bunch, basically.
Okay, and
Ryan was a stay-at-home dad for 2 years.
I was.
Oh, cool. I'm jealous.
Yeah.
I think this is my personal take. Nothing against self-storage. I think they're 90% of the time the biggest waste of money for consumers, because most of the stuff people are putting in these things, after a year of paying for the storage unit, you could have paid for new furniture instead of putting it in there. That's just my take. My fiance put her stuff in a storage unit for 2 years. It wasn't worth half of what we paid to keep it in there. I tried to tell her that from the get-go.
I agree with the second half of your statement, but I don't agree with the first half, and here's why. Why did your wife do that, or your fiance do that?
Why did she have? Because she was emotionally attached to everything.
Oh,
she can't get rid of anything.
Okay, so
and because she had to move, right? So she had to move from Kansas City to St. Louis for a short time.
Yeah, maybe she held on too long, and that's the stickiness of the business. But just that like Ryan, yeah, people are using these units for life events.
Yeah.
Period. Right. So when you think about why people are using self-storage, it's not because, oh, I got too much stuff, right? Like, I mean, maybe that is the case. Maybe you do have too much stuff. Okay, that's a different debate. But like, you're using it. What triggers the event is a move. I'm a traveling nurse. I'm a sheet metal contractor. I can't operate out of my home. I have an HOA that doesn't allow me to park my truck in the driveway anymore. whatever it might be, people are using this for life events and for businesses, not because they, hey, my house is overflowing. It might be, but there might be a trigger like, hey, I want an office room in my house because of COVID, or I want a workout room in my house because of COVID. So people are using this because of life events. And so when you think about, I don't know what the original question was, but my point is that the demand for self-storage is going to be, I know what it was. People don't want these in every market, right? So the city planners and this and that.
Yeah.
So rich or poor, old or young, middle-aged, whatever, everybody has these life events. So every single community needs a self-storage. And so when you artificially limit the supply, you're going to artificially increase the price. So when you can look at these markets and these city planners, like great example, we have a property in Sandy, Oregon, and the city hates self-storage.
Where is Sandy, Oregon? Just real quick.
It's 35 minutes southeast of Portland on the way out to Mount Hood.
Okay.
We built this really nice 50,000 square foot tiny property, right? That's a small new build. But that was the most we could build, the most that they would let us build. And it took 5 years to get this project approved. And as soon as we got it approved, they took the vote to city council and they said, hey, we allowed self-storage in commercial zoning like C1 or something like that. And we want to remove it as a permitted use because we don't want any more storage in the commercial zoning. We're filling this property up in less than a year, and we're charging, some units are getting $33 annual rents, meaning that a 5x5, a 25 square foot unit is getting about $70 a month. $70. That is more expensive than multifamily, right? Per square foot. So the city doesn't want any more of it. So guess who pays? The consumer. And it's because there's no demand, there's no supply in that market for storage. So, when we go in front of a lot of these city council hearings, when we're trying to get this stuff approved, because we've done rezones, we've done, extensive entitlements, we tell you like, hey, the saturation in your market is very low, the demand is very high, and you're artificially limiting your citizens. And all it's going to do is cost them more money because we're going to be able to demand higher rents,
Yep.
And because there's no supply. It's a simple economic supply and demand issue, right? So not to go on a tangent about it, but just to give you some perspective of,
I think that was great.
Yeah,
people need to understand that happens across the board, though, not just self-storage. I mean, practically everything in different cities when they're going and they're limiting multifamily. That's been a big thing in the past decade or so, as a lot of cities said, well, we don't want any more multifamily, so we're going to eliminate that from any future use and whatever else. Well, now people have gone back and got a lot of rezonings done, everything else, but that was a problem for years. And all it did was increase the cost for the consumer across the board.
Well, it's like affordable housing. We don't have an affordable housing crisis. We have a zoning.
That's a great buzzword, isn't it?
Yeah. We have zoning. You get rid of zoning, you have no affordability problems because you can build whatever you want, wherever you want, right? And there's a lot of people that need housing, so you could build housing in more places. So, and same thing with self-storage. So you got to be careful, right? Because you might be offered an opportunity to buy a property in a market that this is commercial zone, you can put storage there, and then you peel the layers of the onion back and you find that there's a moratorium, or you find that there's restrictions, or it requires a CUP, which is going to be risky in the entitlement phase. So we build these all over the country now, and we buy existing. So we have two funds. One fund allows us to we buy existing properties for investors who just want that immediate pop and cash flow with upside. And then we have a ground up fund that just focuses 100% on ground up fund, which has more upside, but more irregular cash flow. So you're in there and you're trying to replace income. Not a very good one, but if you're kind of looking for those higher returns, we have a growth fund for that. So
let's talk a little bit about these funds and the different opportunities that you guys offer. So what's a deal look like? So say that first off, let's talk about this DST fund that you mentioned prior to the start of this podcast. Tell me if I'm wrong. That's a Delaware trust fund. Is that accurate?
Delaware Statutory Trust. Yep.
Okay. Explain what that is and why that versus like a 506B or C.
Yeah, so it actually is a 506C offering, which is kind of funny. Okay. So I've learned ton about this in the last 2 weeks. So I've got like Dunning-Kruger effect here. I'm like on the peak of Mount Stupid. I think I know everything, but I really know nothing. So bear with me. I'm like just enough to be dangerous. Yeah. So the Delaware Statutory Trust, that's a fancy way of saying it's like a tax deferment vehicle, right? It's a tax deferment strategy that was drafted in 2004, and it allowed people who had 1031 exchanges to pool money together into an investment opportunity and tax defer. Right. So if you're a 1030, you got a collection of single family homes, you're thinking about selling them and you want to roll those tax free into an investment, but you don't want to manage it anymore. You want to be passive. You just want to get this into an asset that you like. You want to be in hard real estate, but you don't want to be, in you don't want to be in the management of it anymore, right? So these DSTs also, allow an interest in the DST. So, it could be the three of us rolling our 1031s and getting a percentage based on how much we roll in of the DST. And that gives you the opportunity to get access to institutional quality opportunities, because obviously if you're only rolling over $1 million or $500,000 or whatever from your 1031, you might go into a deal that's $15-20 million, more institutional quality real estate with a higher end operator like Spartan. So what we just decided to do as a recap strategy is, we have investment. We built a big operating company, right? So we have Free Up Storage is our opco. We don't want to lose our assets, right? We want to keep our assets in our portfolio. We want these to be evergreen. We also wanted to cash out our LPs, right? Our limited partners, our passive investors. They're looking at us, and we're in closed-ended funds. So like at some point, we got to sell these things, right? And it's great to turn and burn, get in, and a couple of years, 3 years, 4 years. Sell your property, make your investors good money, but guess what they get? They get stuck with a big tax bill and a problem, right? They get a tax bill because they got to pay the gains on the sale, and then they don't have anywhere to put their cash, right? Then they got to find another opportunity or whatever. So what's cool about the DST is we actually are selling the property into a DST fund. Property we've owned for 5 years.
Okay.
We know the financials in and out. We got a third-party appraisal, broker opinion of value, multiple ways of valuing the asset. We're selling it into the DST fund, and the investors that are in there, they have an option. They can roll their proceeds forward, tax deferred, and continue benefiting from the property at a basis that's much higher, so their cash flow is really not going to change, or they can get cashed out. It also allows any 1031 investors in our network to 1031 exchange into the Delaware Statutory Trust and tax defer and get a piece of this really nice storage asset. So really, really cool vehicle.
This might be getting into the weeds, but let me ask you on that. So I've got a 1031 exchange. I sell my property. When you do that, you have to exchange for like kind property, correct? Yep. The tax code. And we aren't CPAs or professionals. We're just chatting here. Yep. When I do that, they say, okay, it has to be like kind. Okay, say we got the like kind, that's fine. But it also, when it comes to the note of the property, you have to essentially have the same note or more going forward on that property. How does that work? So say I sell a house in Kansas City that I own, a rental, 1031, if the note on it was $100,000, how do I still have that $100,000 or larger note in this DST fund?
Yeah, check with your QI or your CPA, but we're just having a conversation here.
Yeah.
Giving tax advice is really dangerous, so I'm not doing that.
Exactly.
Because your situation might be different. I mean, I can't stress that enough. Typically, if you have
your understanding is this.
Yeah, my understanding. Yeah, exactly. When you have a 1031 exchange and there's debt, you have to because an investor, if you're doing this, you're going to get an investor that says, hey, I've got $1 million of debt to roll over and $1 million of cash to roll over. Mm-hmm. The reality is the $1 million of cash is really the only money you're actually going to see. The $1 million of debt that they're rolling over is something that they have to find replacement debt that they become a guarantee of. So if your 1031 exchange is going into a DST that doesn't have any debt, that can't be assigned to that, then there is no opportunity to roll your debt over, and there may be tax consequences to that. What they are, I don't know. I'm not going to even
exactly. Yeah.
So that is a thing. So if you're holding a property in all cash and you're selling it and you're 1031 exchanging it, and there's no debt on the property, this specific opportunity doesn't have any debt. The first DST we did, we hired a top law firm, Polson LA. They're like one of 3 law firms that,
they're great.
Yeah, that do these transactions. So we went with a top law firm for that. And we got a lender that actually was willing to lend us the cash. But we said, this is our first one. Let's just do it all cash.
So you guys are raising all cash. There's no debt to take. So if I had that debt, I really talk to my accountant and everybody else, but I probably, it would need to be a paid off property that I'm selling to then roll over.
It wouldn't be limited, but I would bet you would have a tax consequence to the debt you didn't roll over. So I would just, again, I don't know what that is, and double check with your planners that are.
No, that is very interesting though. I was not aware of these DST funds before this.
And
the fund, technically, that would mean the property is owned by the trust, because you're setting up a trust essentially there.
Yep.
And then you own a piece of that trust.
We don't own. Spartan doesn't own anything.
The investors own
100% of the DST. So we sell off all the interest. So we're just the trustee of the trust. So we're the operator. We set up a master lease agreement with the as the master tenant, and we operate the property. And so,
what do the numbers look like, or what are they projected to look like for an investor?
So obviously, this is an unlevered opportunity, right? So we're not using any debt. So when you think about risk, we've completely mitigated a lot of the bank risk, right? There's no debt or anything like that. This is a stable property. There is no expansion. There's no value add upside on the improvements to the property. Things like this is as stable as you get. And so we're looking at about a 12% annualized return for our investors over the 7-year hold period. So it's not your double your money in 5 years, typical syndication. It's going to have a little bit of, I think the average cash flow is about 7% through the life of the hold. So not bad. So it's a good opportunity, but it's not a slam dunk, triple your money or anything like that. And that's intentional, because when you have a DST, there's some restrictions on how you structure it. Number one, you can't change the capitalization plan after you stand up the trust and sell the interests. You can't say, oh, I need another $1 million for this project. You can't do that. You have to set the capital stack and leave it alone. You can't touch it. So typically you want assets like this going in there that are stable.
So, and there's people out there that's what they want, right? I got a lot of people I'm talking to right now that they've got a ton of paid off properties. A lot of older folks, they just want the cash flow, and they don't want notes on it. So if they did want to, okay, we no longer want to manage these ourselves. We don't really want to own our finance, but we also don't want to pay taxes. This is a great opportunity for them to kind of then roll up into a 1031 and not get the tax hit against them, and essentially maybe get a little bit less return, but it's a lot safer because you don't have any debt against the property, so you're not going to go belly up on that piece.
Or if you want a 1031 and it's like, I can't find anything to roll it into, you got to find other options. And here's an option.
Yeah. And the other thing too, is this isn't limited to 1031 exchange investors or those investors that rolled over. We have investors that sometimes want us to have a single, they want to know exactly the property they're investing in, so they can still invest cash and there's no consequences to that. And also if you're a self-directed IRA investor, you're not going to be paying any UDFI because there's no leverage. So it's a great opportunity really for a lower return and a lower risk. It's a core plus deal basically, right? So I'm pretty excited about it. I'm pretty stoked. I spent hours and hours and hours with our attorneys on how this is all structured, and oh my God, I'm like, there's just so many more things in real estate that I didn't know about. And man, they get creative.
So much. Every day I'm learning something new. I'm like, geez, Louise, this is so neat.
So
you guys raised the money for that already, or is that already done?
This is brand new. And so if you guys, if your listeners want, we're actually going to host a webinar on June 7th, I think.
Okay.
we can put the thing in the show notes. We're going to talk all about it. It's not gonna be like necessarily about the deal. It's going to be about kind of what we're doing in general.
Yeah,
kind of more of a deep dive. Yeah, more of a deep dive into that. So let me just make sure I get the dates right. But
I think a lot of people will like that too, because it's not one of these deals like a lot of funds. What they're doing is they're going out, they're raising the capital, and then the end goal is to kind of stabilize it, sell it, make your money, go again, right? This is more so, hey, we're going to hold this thing long term. We don't need to sell it, you know. And if people were to want out, could they
the cash out
okay, and then you just bring another investor in that wants to get in.
And that's the thing, like, I talk to a lot of investors, obviously we have thousands of investors right now, and a lot of people are like, hey, they're like, I just want to turn and burn. And I'm like, okay, cool, you can do that. These are closed-ended funds, we're going to turn and burn. Or some investors say, I don't ever want to sell the asset. Like, I don't want to ever pay the tax. I'm like, okay, we can do that now too.
Offer in multiple different ways. That's perfect.
Yeah. And then for us, the benefit is you got to keep in mind, what's going on with the syndicator, because the syndicator, the operator, we need monthly recurring revenue, right? And so when we sell property, we lose our monthly recurring revenue on the asset. So it's a way we're going to build our portfolio. Because we're hiring world-class people. We just hired the vice president of asset management from Extra Space, the largest self-storage operator. That comes at a cost, right? Yes. And then when we have vice presidents and marketing people, and we're hiring the best talent out there, if we start turning over our portfolio, guess what? We don't have that recurring revenue that it's required to keep the engine on and keep world-class operations going, right? So you got to think about, like, we want to hold this asset. And plus, we'll sell property. Like, admittedly, that property I talked about that's selling in a week in the beginning of the show, that property, it doesn't fit our portfolio. So, it's a good property and someone's going to do really well with it, but it's too small and it's not really our jam, right? So we'll trim the properties that we don't want, that are good opportunities for people, but we'll keep the assets that, we want to build the portfolio with. One last thing too, and I don't have a ton of detail on this, but you can also do a 721 exchange out of a DST, and you can break it up into a non-traded REIT. So if you're that 65, 70-year-old retiree and you have kids that have no interest in your property, now you can break it up into shares and you can have better estate planning management. So there's so many. Yeah, and I haven't really gotten into that too much, but that is another really good estate planning strategy for those that are thinking about retirement and things like that. So this is just a number of different things to think about when it comes to that.
That's awesome. Well, we could talk all day. I want to hit a few things real quick. What's Spartan's end goal? Like, what are you guys really trying to achieve or do? What's next?
Yeah, so so we have a strategic plan. You can go to our website and spartan-investors.com, and you can download our strategic plan, and it outlines exactly what our next 3 years look like. We want to get to $5 billion in AUM at the end of 2025. We want to get to $1 billion a year in annual revenue. Right now, we're probably right around 100 million. We want to build a team that has the capacity to get a net promoter score of at least a 52 or higher across all departments, across all customer bases. We want to have, excellence in everything that we do. And then long term, our goal is 100,000 active investors and creating wealth for every Spartan. That's kind of our big, hairy, audacious goal. That's our long-term goal. And that's cool. Really that's it. I mean, those are our three main goals: 5 billion, 1 billion, and 52 net promoter. And then our BHAG is 100,000 investors and wealth for every Spartan, which means different things to different people. Right?
Exactly.
Yep.
And what's it look like to become an investor?
Yeah. So our minimums are 50K, and you can just sign up on our website. And our growth fund, like I said, it's about a 2.3 multiple over 5 for our ground up stuff, and then our existing value.
Explain that for somebody that has no clue, like Ryan. He doesn't know much. Yeah. What does that mean? If I put 50,000 in, you give me a 2.3 multiple.
That means that if you give me 50 grand, I'll give you that back plus about 70 grand in 5 years. So
beautiful.
Bam.
I had one more, we're getting long on time, but I had one more question, and this is more just your personal feelings and how it was for you. You guys started in 14. just doing like flips and stuff like that. And now coming up almost on 10 years later, you're over 115 people on your team, 11 states. Was it pretty gradual, or did you wake up one day like, oh my, we're a big operation here?
Yeah, that was pretty much every day, like from 2022 and from 2020 and on. I mean, it was, it's really funny. When we're thinking about hiring people, it was like, well, we just need another accountant, so we're like, okay, we'll post the job and and then we're like, and after that hire, we'll be good, and then
as soon as you hired them, you needed 2 more.
Yeah, and then it was like, well, why don't we hire another, this, and it was like, and all of a sudden the employee count just skyrocketed, and if you ask any Spartan, there is no shortage of time. I mean, there is no shortage of work to do, I should say. We have, I mean, it is a very lean, mean machine, and we're doing a lot with the people that we have, and they do great work. But yeah, it really grew. And so at this point now, we just, one of our quarterly rocks was to put up a staffing plan, based on, if we want to go to this, what's it going to require, and what headcount are we going to need? And it's interesting, when you start off in real estate, it's all about the deal and the investors and operations and all that. But like, now for me, it's like all about leadership, and it's all about organizational structure, and it's all about hiring plans, and spending time with my team and things like that. So it's it changes, it changes from different stage. Yeah, and that's kind of the stage that we're at now. So
very cool.
That's awesome. And before this is the actual last question. Yeah. What motivates you? What drives you to continue to grow this and do more and more and more? Because it's not easy to wake up every day and keep the energy. You've got a lot of energy. I could see the passion. But it's tough. I mean, being a business owner, having that many people to look out for, the investors, everything. What motivates you?
Yeah, I would say, I want to provide an environment where people can grow personally and professionally. And I want to create wealth for my investors. And that's actually right in our vision statement. So what that means is, what's the story there? It's, when I see an employee succeed, when I see an employee take a promotion, when I see the leaps that they take in leadership, and they start to understand, how to lead people and how to get in there and make, good decisions and grow, that is rewarding to me. That's motivating to me. On the investor side, we're about to pay out a really nice multiple and a really great return. My rewards come when we pay investors. I mean, 100%. It's like when we make a big distribution or we have a big exit. That's when I'm like, this is why we do this, right? So it's all about the team growing personal and professional. It's all about, providing well-vetted opportunities for our investors, and providing great returns to them. So for me, that's it. I mean, those are the 2 things that keep me going.
I love it.
Yeah. So it's been a lot of fun.
Great. Well, to wrap it up, tell everybody where they can find you, drop your social media platforms, whatever you got.
Awesome. Yeah. Well, thanks for having me. If you want to get in touch, you can go to Spartan-investors.com. You can email me, Ryan@Spartan-investors.com. I'm not afraid to put my email out there.
That's probably a good thing.
Yeah. And you can catch me on LinkedIn. I think I'm like Ryan Gibson 01 or something like that. So yeah.
Awesome. Well, Ryan, we can't thank you enough for coming on the show. Some great knowledge and information in the space, and best of luck to you guys. You guys are crushing it. I hope you guys continue to crush it, and please let us know the same thing we can do to help you guys continue to grow.
Awesome. Thanks for having me.
Yeah. So to wrap it up, bunch of stuff happened on this podcast. All the links he mentioned to the video and the investment stuff and the June 7th, the webinar, I'll link it all in the description. Thank you everybody for listening. Please like and subscribe wherever you listen to podcasts. And as always, we'll catch you on the next one.